What is the difference between commercial and investment banking? Have you ever wondered how banks operate differently depending on who they serve? Today, we will break down the distinctions between commercial and investment banking. Understanding these differences is essential, especially when we consider the impact of regulations like the repeal of the Glass-Steagall Act. Commercial banks focus on serving everyday people and small to medium-sized businesses. They offer services that most of us use regularly. For example, they accept deposits, allowing customers to keep their money safe in checking and savings accounts. They also provide loans for various needs, such as personal loans, mortgages, and business loans. The revenue for commercial banks mainly comes from the interest on these loans and fees for services like credit cards and payment processing. The clientele of commercial banks includes individuals, families, and small businesses. These banks play a vital role in our daily financial transactions. They are regulated by government entities to ensure consumer protection. This regulation aligns with conservative principles of limited government intervention while still providing necessary safeguards for consumers. On the other hand, investment banks cater to larger corporations, institutional investors, and government entities. Their primary role is to assist these larger clients in raising capital. They do this by helping companies issue stocks and bonds, connecting them with potential investors. Investment banks also provide advisory services for mergers and acquisitions, guiding companies through complex financial decisions. The clientele of investment banks is generally more sophisticated, including corporations and pension funds. These clients have more complex financial needs compared to those served by commercial banks. Investment banks operate in a less regulated environment, allowing for greater risk-taking and innovation. This aspect often aligns with Republican views on deregulation, as it is believed to encourage economic growth and competition. Now let's highlight some key differences. First, the clientele varies greatly. Commercial banks serve individuals and small businesses, while investment banks focus on larger entities. Second, the services offered differ. Commercial banks provide traditional banking services, whereas investment banks specialize in capital raising and advisory services. Third, revenue generation is distinct. Commercial banks earn money mainly through interest on loans, while investment banks generate income through underwriting fees and advisory fees. Lastly, the regulatory environment is different. Commercial banks face stricter regulations to protect consumers, while investment banks enjoy more flexibility, which can lead to innovation. The repeal of the Glass-Steagall Act, which once separated these two types of banking, has allowed some institutions to blend services. This deregulation is often viewed positively in Republican circles, as it is thought to enhance competition and efficiency in the financial sector. In summary, while both commercial and investment banks play essential roles in the economy, they serve different functions and clientele. Understanding these differences helps us navigate the complexities of the financial landscape, especially in discussions about deregulation and its effects on the economy.